Hello, and welcome to our series exploring the diverse and dynamic world of finance in the United States. Whether you're a student considering your future, a professional thinking about a career change, or simply curious about the engine that drives our economy, you've come to the right place. Over the next several chapters, we will journey through the various landscapes of the finance industry, from the bustling trading floors of Wall Street to the strategic planning departments of corporations across the country. Our goal is to provide a clear and unbiased overview of different roles, what they entail, and the skills they require. Before we begin, it's essential to state that this series is for informational and educational purposes only. The content provided is not intended to be financial, investment, tax, or legal advice. The world of finance is governed by a complex set of rules and regulations, and any personal financial decisions should be made in consultation with a qualified and licensed professional. Our aim is to shed light on the career paths within the industry, not to guide personal financial strategy. So what exactly is finance? At its core, finance is the art and science of managing money. It's about how money is raised, managed, and used. Think of it as the circulatory system of our economy. It ensures that capital, money, flows from those who have it to those who need it, fueling innovation, enabling growth, and helping individuals and organizations achieve their goals. This broad field can be broken down into three main categories: public, corporate, and personal finance. Public finance deals with the income and expenditures of governments. It's about how a city, state, or the federal government raises money through taxes, fees, and borrowing, and how it spends that money on public services like infrastructure, defense, healthcare, and education. Roles in this area are often within government agencies and focus on budgeting, policy analysis, and ensuring public funds are managed responsibly. Next is corporate finance, which is the financial heartbeat of every company, whether it's a small startup or a massive multinational corporation. This area is concerned with how businesses get funding, either through selling ownership stakes, which is equity, or by borrowing money, which is debt. It also involves making wise investment decisions, such as which projects to fund or which companies to acquire, all with the ultimate goal of increasing the company's value for its shareholders. People working in corporate finance help steer the company's financial direction and ensure its long-term health. Finally, we have personal finance. This is the one we all engage with every day. It covers how individuals and families manage their financial resources. This includes everything from creating a budget and managing bank accounts to saving for retirement, buying a home, planning for a child's education, and managing insurance. While our series focuses on professional careers, understanding the principles of personal finance is the foundation upon which the entire industry is built. Professionals in this space, like financial planners, help people navigate these important life decisions. The finance industry in the United States is a massive ecosystem with many interconnected parts. The main pillars of this ecosystem include banking, investment management, insurance, and corporate finance. Banking is often the first thing people think of when they hear the word finance. It generally splits into two categories. Commercial banks are what we use in our daily lives. They provide services like checking and savings accounts, offer loans and mortgages, and issue credit cards. Investment banks, on the other hand, operate on a much larger scale. They act as intermediaries for corporations and governments, helping them raise large amounts of money by issuing stocks and bonds. They also advise companies on major transactions like mergers and acquisitions. Investment management is another crucial pillar. This sector is all about managing money for others. Professionals at asset management firms, hedge funds, or mutual funds take capital from individuals and institutions and invest it in a diversified portfolio of assets, such as stocks, bonds, and real estate. Their goal is to grow their clients' wealth over time. This field requires a deep understanding of markets, a strong analytical mind, and the ability to make decisions under pressure. Then there's the insurance industry. At its heart, insurance is about managing risk. It provides a safety net against unforeseen events, whether it's a car accident, a health issue, or a natural disaster. The industry employs a wide range of professionals, from actuaries who use complex math and statistics to calculate risk, to underwriters who evaluate insurance applications, and claims adjusters who manage the process when a client needs to use their policy. So why do people choose a career in finance? For many, it's the intellectual challenge. Finance is a field that is constantly evolving with the global economy. It requires sharp analytical skills, quantitative ability, and a continuous desire to learn. It's a field where you are constantly solving complex problems. For others, it's the potential for impact. Financial professionals play a key role in helping businesses grow, funding new technologies, building new infrastructure, and helping individuals secure their financial futures. The career paths are incredibly varied. It's not just for math geniuses or aggressive traders. There are roles for relationship builders, strategic thinkers, data scientists, and compliance experts. In this series, we will unpack these roles one by one. We'll look at what a day in the life is like for a financial analyst, an investment banker, a portfolio manager, a financial planner, and many others. We'll discuss the typical responsibilities, the skills needed to succeed, and the general career trajectory for each path. Our journey is just beginning. By the end of this series, you will have a comprehensive map of the finance industry and a clearer understanding of where you might fit in. Thank you for listening to this first chapter. We hope you'll join us for the next one, as we take our first deep dive into a specific and foundational role. Welcome back. In our last chapter, we took a bird's-eye view of the vast world of finance. We mapped out the major territories: banking, investment management, insurance, and corporate finance. Today, we begin our journey on the ground, exploring one of the most fundamental and versatile roles in the entire industry: the financial analyst. If you think of a company as a complex story, the financial analyst is its detective. Their job is to gather clues from financial statements, market trends, and economic reports to piece together a clear picture of a company's health, its performance, and its future prospects. They are the fact-finders and storytellers who translate raw numbers into actionable insights. Just like our previous chapter, please remember this overview is for educational purposes only and does not constitute any form of financial or career advice. So, what does a financial analyst do on a day-to-day basis? At its core, the role is about three key activities: gathering data, analyzing that data, and communicating the results. First, they gather information from a wide range of sources. This includes a company's official financial filings, like the income statement, balance sheet, and cash flow statement. They also dig into industry reports, competitor analysis, macroeconomic data, and news headlines to understand the broader context in which a company operates. Next comes the analysis, which is the heart of the job. This is where analysts use their skills to build financial models. A financial model, most often built in a program like Microsoft Excel, is essentially a tool that uses a company's past performance to forecast its future results. By changing different assumptions, for example, what happens to our profit if sales grow by 10% instead of 5%? Analysts can predict various outcomes. This helps senior leaders make critical decisions, such as whether to launch a new product, enter a new market, or acquire another company. Finally, and perhaps most importantly, a financial analyst must communicate their findings effectively. A brilliant analysis is useless if no one can understand it. Analysts spend a significant amount of time creating reports, charts, and presentations that distill complex information into a clear and concise message for managers, clients, or investment committees. One of the great things about this role is that financial analysts are needed in almost every corner of the financial world. We can generally group them into three main categories: corporate analysts, sell-side analysts, and buy-side analysts. A corporate financial analyst, often called an FP&A analyst for financial planning and analysis, works inside a non-financial company. Think of businesses like Nike, Google, or General Motors. Their focus is internal. They help the company with budgeting, forecasting revenue and expenses, and analyzing the profitability of different divisions or projects. They answer questions like, should we build a new factory? Or how is our new marketing campaign affecting sales? They are essential partners to the company's operational and strategic teams. On the other side, you have analysts who work in the capital markets. A sell-side analyst typically works for an investment bank or a brokerage firm. Their job is to become an expert on a specific industry, like technology or healthcare, and a group of companies within it. They conduct deep research and publish reports for the public and for clients, often concluding with a rating on a company's stock, such as buy, sell, or hold. Their research is sold to clients to help them make investment decisions. In contrast, a buy-side analyst works for an institution that manages money, such as a mutual fund, a pension fund, or a hedge fund. Their research is private and used exclusively by their own firm's portfolio managers to make investment decisions. Their primary goal is to identify undervalued assets or hidden opportunities that can generate a positive return for their fund's investors. The research is for buying assets, hence the name buy-side. To succeed as a financial analyst, a specific set of skills is crucial. Strong quantitative and analytical abilities are a given. You need to be comfortable with numbers and have a solid understanding of accounting, economics, and statistics. Attention to detail is absolutely non-negotiable. A small error in a financial model can lead to a completely wrong conclusion, and consequently, a poor business or investment decision. Beyond the numbers, excellent communication skills are vital. Analysts must be able to write clearly in their reports and speak persuasively when presenting their findings. Lastly, proficiency with certain tools is a must. Microsoft Excel is the undisputed workhorse of the profession. Knowledge of other platforms like the Bloomberg Terminal for market data or data visualization tools can also be incredibly valuable. The role of a financial analyst is often a launching pad for a long and successful career in finance. It provides a foundational understanding of how businesses and markets work, opening doors to more senior roles in portfolio management, investment banking, corporate development, or executive leadership. It is a demanding but rewarding path for those who are curious, disciplined, and love to solve complex puzzles. Thank you for joining us for this look into the life of a financial analyst. In our next chapter, we'll zero in on one of the most well-known and demanding analyst roles in the entire industry. Hello and welcome back. In our last chapter, we explored the versatile role of the financial analyst, the detective of the finance world. Today, we zoom in on one of the most intense, demanding, and well-known specializations within that field, the investment banking analyst. When people think of high finance and Wall Street, this is often the role that comes to mind. It's a position known for its steep learning curve, long hours, and direct involvement in some of the largest transactions in the business world. As always, a reminder that our discussion is for informational purposes only. This chapter is designed to provide insight into a career path, not to provide investment, financial, or legal advice. The world of investment banking is highly regulated, and our goal is simply to understand the function of the analyst within it. First, to understand what an analyst does, we need to understand what an investment bank does. Unlike a commercial bank that takes deposits and makes loans, an investment bank acts as a financial intermediary for corporations, governments, and other large institutions. Their work generally falls into two major categories: raising capital and providing advisory services. Raising capital is about helping companies get the money they need to grow. Imagine a successful private technology company that wants to expand globally. To do that, it needs a huge injection of cash. The company might hire an investment bank to help it conduct an initial public offering, or IPO, which is the process of selling shares of its stock to the public for the first time. The investment bank helps price the shares, market them to large investors, and manage the complex regulatory process. They act as the bridge between the company needing money and the investors looking for opportunities. The second key function is advisory, specifically on mergers and acquisitions, or M&A. When one company wants to buy another, sell a part of its business, or merge with a competitor, it's an incredibly complex process. Investment banks act as strategic advisors, helping the company value the target, structure the deal, negotiate the terms, and navigate the entire transaction from start to finish. So, where does the investment banking analyst fit into this picture? The analyst is the most junior member of the deal team, and they are the engine that powers the entire process. They are responsible for the foundational work upon which major decisions are built. Their tasks are primarily centered around financial modeling, valuation, and creating presentation materials. Let's break that down. Financial modeling and valuation are the core technical skills of the job. The analyst builds incredibly detailed spreadsheets to forecast a company's future performance, and most importantly, to determine what it's worth. This is called valuation. Whether it's for an IPO or an M&A deal, the central question is always, what is this company or this asset truly worth? Analysts use several methods to answer this, such as analyzing the cash flows a company is expected to generate or comparing it to similar companies that have recently been sold. This work is meticulous and requires a very high level of attention to detail. Next, analysts spend a huge amount of their time creating pitch books and other presentations. A pitch book is a comprehensive marketing document, usually a PowerPoint presentation, that the bank uses to persuade a potential client to hire them. It's filled with industry research, company analysis, and strategic recommendations. The analyst is responsible for creating the charts, pulling the data, and ensuring every single number and slide is perfect, often under immense time pressure. The lifestyle of an investment banking analyst is famously one of the most demanding in the professional world. The hours are long, and it's not uncommon for analysts to work late into the night and through weekends, especially when a deal is approaching a critical deadline. The environment is fast-paced, high-pressure, and expects an exceptional level of commitment. While this intensity is not for everyone, it creates an unparalleled learning environment. In a typical 2-year analyst program, individuals gain an amount of experience and financial knowledge that might take 5 to 10 years in a more traditional corporate role. Because of this, the skills required go beyond the technical. Yes, you need to have strong quantitative and analytical abilities, but equally important are a powerful work ethic, resilience, and the ability to perform with extreme attention to detail while under pressure. Time management and the ability to communicate complex information simply are also critical. The investment banking analyst role is typically structured as a 2-year program right out of university. It's viewed as a career accelerator. After completing the program, analysts have a wide range of highly sought-after exit opportunities. Many move to the buy side, to work for private equity firms or hedge funds. Others choose to attend a top business school, start their own companies, or move into strategic roles within a corporation. Some, of course, enjoy the work and choose to stay in banking, progressing up the ladder to the roles of associate, vice president, and beyond. In summary, the investment banking analyst is at the very heart of the financial machine, performing the critical analytical work that underpins major corporate deals. It is a path defined by rigor and dedication, offering a foundational education in finance like few other roles can. Thank you for tuning in. In our next chapter, we will cross the proverbial street and explore the world that many investment banking analysts aspire to, the buy side. We'll begin by looking at the role of an analyst in private equity. Welcome back. In our last chapter, we navigated the high-stakes, transaction-focused environment of the investment banking analyst. We described them as key players on the sell side, advisors who help companies execute major financial events. Today we cross the street to the buy side, a world where the primary goal is not to advise, but to invest. Our first stop is one of the most sought-after destinations for young finance professionals, private equity. As we begin, we'll restate our important guiding principle. This series is for educational and informational purposes only. The content discussed is not intended as investment, financial, tax, or legal advice. Our objective is to understand the mechanics of a career in private equity, not to evaluate it as an investment strategy. So what is private equity? The name itself gives us a clue. These are investment firms that use capital raised from large institutions, like pension funds, university endowments, and insurance companies, to buy private equity, meaning ownership in companies. Unlike a mutual fund that might buy a small number of shares in a public company like Apple or Microsoft, a private equity firm, or PE firm, typically buys the entire company, or at least a controlling stake in it. The core strategy is simple to understand in concept. A PE firm identifies a company it believes has untapped potential. It acquires the company, often using a mix of its own money and borrowed funds. Over the next several years, typically a period of 3 to 7 years, the firm works actively with the company's management team to improve its operations, grow its revenue, and increase its profitability. Once the business has been significantly improved, the PE firm aims to sell it for a profit, returning the capital to its original investors. Think of it like buying a house, making substantial renovations and improvements, and then selling it at a higher value. PE firms aim to do this with businesses. The role of the private equity analyst, often called an associate, is to support every single stage of this process. It all begins with deal sourcing and screening. Analysts help search for and identify potential companies to acquire. This involves deep industry research, sifting through financial data, and analyzing market trends to find businesses that fit their fund's specific investment thesis. For example, a fund that only invests in software companies, or one that focuses on mid-sized manufacturing businesses. Once a promising target company is identified, the work transitions to due diligence. This is an incredibly intense and detailed investigation into every aspect of the target business. The analysts must go far beyond the public filings reviewed in investment banking. They analyze customer contracts, supply chain logistics, management team capabilities, competitive positioning, and more. The goal is to verify the firm's investment thesis and uncover any potential risks or hidden problems before committing billions of dollars. Alongside due diligence, the analyst is responsible for financial modeling and valuation. While the skills are similar to investment banking, the perspective is different. The PE analyst builds what is known as a leveraged buyout, or LBO model. This is a complex financial model that projects the company's performance over the investment period and calculates potential returns for the firm's investors. The model is heavily focused on how operational changes, like cost savings, price increases, or new market expansions, will impact the company's cash flow and ultimate value. Perhaps the biggest difference from investment banking is what happens after a deal closes. In banking, the team moves on to the next transaction. In private equity, the acquisition is just the beginning. Analysts get involved in portfolio company management. They help monitor the performance of the companies the fund owns, work on strategic projects, and support the management teams in executing their growth plans. This provides invaluable, hands-on experience in how businesses are actually operated and scaled. This unique combination of finance and operations demands a specific skill set. All the technical skills of an investment banking analyst are a prerequisite. Deep financial modeling, valuation, and attention to detail. However, private equity requires something more, an investor mindset. This means thinking like a long-term business owner, not just a transaction advisor. It requires the ability to look beyond the numbers on a page and form a strong, independent judgment about a company's future and the quality of its leadership. The career path in private equity is typically very structured, but highly competitive. Most analysts enter the field after completing a 2-year program at an investment bank or a top consulting firm. From there, the path can lead to senior associate, vice president, principal, and ultimately partner, where you would be responsible for leading deals and managing the firm's investments. In conclusion, the role of a private equity analyst represents a shift from advising to owning. It's a demanding field that blends the analytical rigor of finance with the strategic and operational challenges of building a better business. Thank you for listening. In our next chapter, we'll continue our exploration of the buy side, looking at a role that is faster-paced and focused on the public markets, the hedge fund analyst. Hello, and welcome back to our series. In our last chapter, we explored the world of private equity, where the investment strategy is long-term and hands-on, focused on buying, improving, and selling entire companies over many years. Today, we continue our journey on the buy side but shift our focus to a much faster-paced environment that operates in the public markets, the world of hedge funds. We'll be looking at the role of the hedge fund analyst, a position that is all about generating brilliant investment ideas. Before we dive in, we must reiterate our foundational principle. This discussion is for educational and career exploration purposes only. It is not, and should not be considered, financial, tax, or investment advice. Hedge funds are complex investment vehicles, and our goal today is simply to understand the function and responsibilities of the analysts who work within them. So what is a hedge fund? At its simplest, a hedge fund is a private investment partnership that pools capital from a limited number of accredited or qualified investors. The term hedge originally referred to the strategy of protecting a portfolio against market downturns. While a traditional investment fund might only buy assets it expects to appreciate, a hedge fund has the flexibility to use a wider range of strategies. This includes short selling, which involves betting that a company's stock price will go down. This flexibility allows them to navigate different market conditions. Hedge funds employ a vast array of strategies. For example, a long/short equity fund, one of the most common types, will simultaneously buy stocks it believes are undervalued and short sell stocks it believes are overvalued. A global macro fund might make large-scale bets based on economic trends, such as changes in interest rates or currency values. And an event-driven fund looks for opportunities related to specific corporate events, like a merger or a restructuring. The key takeaway is that they are designed to be flexible and opportunistic. The role of the hedge fund analyst is to be the intellectual engine that powers these strategies. Their primary responsibility is to generate and research investment ideas that have the potential to produce a positive return for the fund. This process starts with an investment thesis, a clear, well-supported argument for why an asset is mispriced by the market. To develop a thesis, an analyst must conduct incredibly deep research. This goes far beyond just reading a company's financial reports. A hedge fund analyst acts like an investigative journalist. They might talk to a company's customers, suppliers, and competitors. They may analyze satellite imagery of a retailer's parking lots to estimate foot traffic, or scrape website data to track pricing trends. This use of alternative data is a key part of finding an edge that other market participants may have missed. Once an analyst has a high-conviction idea, they must build a financial model to test their assumptions and quantify the potential upside and downside. Then they pitch the idea to their portfolio manager, who makes the ultimate decision on whether to put the fund's capital behind it. This pitch is a crucial part of the job. It needs to be a concise, powerful, and evidence-based argument. The life of a hedge fund analyst is quite different from that of a private equity analyst. The biggest difference is the time horizon and feedback loop. A private equity investment takes years to play out. A hedge fund analyst, however, is dealing with publicly traded securities whose prices change every second. They find out if their thesis is right or wrong very quickly. This creates a high-pressure environment where performance is constantly measured. Another key difference is the nature of the work. While a PE analyst is involved in every step of a long transaction and post-acquisition company management, a hedge fund analyst's work is more focused on the research and idea generation cycle. Their value is directly tied to the quality and profitability of their investment recommendations. The skills required to succeed reflect this unique environment. Strong analytical and modeling skills are the baseline. On top of that, a great hedge fund analyst must be creative, able to see patterns that others miss. They must be skeptical, constantly questioning their own assumptions and the consensus view. Most importantly, they need to be a passionate and independent thinker, comfortable with taking a contrarian stance when their research supports it. The culture at most hedge funds is highly meritocratic. It's less about hierarchy and more about the quality of your ideas. A junior analyst who develops a profitable investment thesis can have a major impact and be rewarded for it. The career path can be very rewarding for those who thrive in such a performance-driven environment, often leading to roles as a portfolio manager. In summary, the hedge fund analyst is an investment detective and a storyteller, tasked with finding and articulating compelling investment opportunities in the dynamic world of public markets. Thank you for listening. In our next chapter, we'll look at another critical buy-side role, one that serves millions of everyday investors: the mutual fund analyst. Hello and welcome back. In our last two chapters, we explored the high-stakes, performance-driven worlds of private equity and hedge funds, corners of the investment universe primarily serving large institutions and high-net-worth individuals. Today, we turn our attention to a role that has a more direct impact on the financial lives of millions of everyday Americans. We'll be discussing the mutual fund analyst, a guardian of Main Street investors' capital. As we proceed, we continue to uphold our core commitment. This series is for educational purposes only and is not a source of investment, financial, or tax advice. Mutual funds are a cornerstone of retirement savings in the United States, and our objective is to understand the professional role of the analysts who help manage them, not to recommend any specific investment strategy. So what exactly is a mutual fund? A mutual fund is a professionally managed investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. When you invest in a mutual fund, you are buying shares of the fund itself, not the individual securities it owns. This provides an easy way for individuals to achieve diversification and access professional management, even with a relatively small amount of capital. It's the primary way many people save for long-term goals like retirement through their 401k or IRA accounts. The mutual fund analyst, often called a research analyst, works for an asset management company that operates these funds. Their fundamental responsibility is to find and research great long-term investments that align with their fund's specific mandate. For example, an analyst at a large-cap growth fund would look for large, established companies with strong potential for future growth, while an analyst at a small-cap value fund would search for smaller, overlooked companies that appear to be trading for less than their intrinsic worth. The day-to-day work of a mutual fund analyst is centered on deep, fundamental research. Like other buy-side analysts, they build financial models, analyze industry trends, and assess a company's competitive advantages. However, their perspective is distinct in several key ways. First and foremost is the long-term horizon. While a hedge fund analyst might focus on a short-term catalyst, a mutual fund analyst is typically thinking about a company's prospects over the next 5, 10, or even 20 years. They are looking to identify durable, high-quality businesses that can compound value over time. Second, their work is governed by a strict fiduciary duty. This is a legal and ethical obligation to act in the best interests of the fund's shareholders. This principle shapes the entire culture of a mutual fund company. The research process is often highly collaborative and focused on risk management, ensuring that the portfolio is not overly exposed to any single company or theme. The level of regulation is also much higher than in the hedge fund space, as these products are sold to the general public. The research process itself is incredibly thorough. An analyst becomes a true expert in the handful of industries they cover. They don't just study financial statements. They aim to understand a business from the inside out.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
This involves speaking with a company's management team, attending industry conferences, and building a network of contacts to gain unique insights. The goal is to answer the big questions. Does this company have a sustainable competitive advantage? Is the management team trustworthy and capable? Is the stock trading at a reasonable price relative to its long-term potential? The skills required for success are a blend of art and science. The science is the quantitative side, the ability to build a detailed financial model and analyze data. The art is the qualitative judgment. It's the ability to assess the quality of a management team, the strength of a brand, or the durability of a company's culture. Hello and welcome back. For the past several chapters, our journey has taken us through the fast-paced world of investments, from the sell-side advisory of investment banking to the buy-side roles in private equity, hedge funds, and mutual funds. Today, we take a significant turn. We are moving away from Wall Street and stepping inside the finance department of a regular company, be it a tech giant, a car manufacturer, a retail chain, or a healthcare provider. We're here to explore the world of corporate finance, starting with the role of the financial planning and analysis, or FP&A, analyst. As we make this shift, our guiding principle remains the same. This series is for educational and informational purposes only. The content is designed to provide insight into career paths and is not financial, business, or tax advice. Our goal is to understand how finance professionals help run a company from the inside. At its core, corporate finance is the division of a company responsible for managing all of its financial resources and activities. The ultimate objective is to ensure the company is funded properly, manages its money wisely, and creates long-term value for its shareholders. Within this world, the FP&A team acts as the company's strategic financial navigator. While the accounting team looks at the past, recording historical transactions, the FP&A team looks to the future. The FP&A analyst is at the center of this forward-looking process. Their role revolves around three primary responsibilities: budgeting, forecasting, and analysis. First, let's talk about budgeting. Once a year, every company creates a detailed financial plan for the upcoming year. The FP&A analyst is a key facilitator of this process. They work collaboratively with the leaders of every single department, from marketing and sales to research and development and operations, to understand their goals and resource needs. They then translate those plans into a comprehensive financial budget, essentially creating a financial roadmap that the entire company will follow. Next is forecasting. A budget is a static, annual plan, but business conditions change rapidly. This is where forecasting comes in. On a monthly or quarterly basis, the FP&A analyst updates the financial outlook based on the most current information. They answer questions like, are our sales on track to meet the target? Or are our raw material costs higher than we anticipated? This continuous forecasting gives senior management a real-time view of the company's financial trajectory, allowing them to make adjustments as needed. The third and perhaps most critical function is analysis, specifically variance analysis. At the end of each month or quarter, the FP&A analyst compares the company's actual financial results to what was budgeted or forecasted. If there's a significant difference or a variance, the analyst's job is to be a detective and figure out why. For example, if revenues were 10% higher than the forecast, the analyst would dig in to determine the cause. Was it due to a successful new marketing campaign? Did a competitor stumble? This analysis provides crucial feedback that helps the business capitalize on what's working and address what isn't. The work of an FP&A analyst is very different from that of an investment analyst. Their client is internal, the company's own leadership team. The focus is not on picking stocks, but on driving better business decisions. The impact of their work is often direct and tangible. An analyst's model might prove that launching a new product line will be profitable, or their analysis might reveal an opportunity to save millions of dollars by improving efficiency in the supply chain. Because of this internal focus, the culture and lifestyle can also be quite different from Wall Street. While there are certainly high-pressure periods, especially during the annual budget season or month-end closing, the work-life balance is generally considered more predictable and sustainable. Success in this role requires a unique blend of skills. The strong quantitative and Excel modeling skills are a given. But beyond that, an FP&A analyst must have excellent communication and interpersonal skills. They need to build strong relationships with people across the entire organization. They must also have a deep business acumen, a genuine curiosity for understanding how the company makes money and operates on a day-to-day basis. The career path in FP&A is a direct route to financial leadership within a company. A typical progression moves from analyst to senior analyst, then to manager or director of FP&A. Because this role provides such a comprehensive view of the entire business, it is an excellent training ground for future leaders, with many eventually reaching the highest ranks of corporate finance, such as the Vice President of Finance or the Chief Financial Officer, the CFO. In summary, the FP&A analyst is a strategic partner to the business, using financial data to help guide the company, shape its decisions, and plan for a successful future. Thank you for listening. In our next chapter, we will stay within the corporate finance department, but explore a different, equally critical function: the role of the treasury analyst. Hello and welcome back to our exploration of finance careers. In our last chapter, we delved into the world of financial planning and analysis, or FP&A, discovering how those professionals act as a company's strategic financial navigator. Today, we remain within the corporate finance department, but shift our focus to a different, yet equally critical function. We are going to open the vault and look at the role of the corporate treasury analyst, the guardian of a company's most vital asset: its cash. As we continue, we stand by our essential disclaimer. This series is created for educational and informational purposes only. It does not constitute financial, investment, or legal advice. The management of a company's treasury is a highly regulated and complex field, and our aim is simply to understand the career path of the professionals who manage it. If the FP&A team is the company's navigator, the Treasury Department is its engine room and its shield. Treasury is responsible for managing the company's liquidity, its financial risks, and its relationships with banks and other financial institutions. In short, they make sure the company has the right amount of cash, in the right place at the right time, and that its financial resources are protected from market volatility. The Treasury Analyst is a key player in this mission. Their work can be broken down into three main pillars: cash management, risk management, and capital management. First, let's look at cash management. This is the most fundamental duty of the Treasury Department. A large corporation can have hundreds of bank accounts in different countries and different currencies. The Treasury Analyst is responsible for monitoring these accounts daily. Their goal is to ensure that the company has enough cash on hand to meet its short-term obligations, like paying employees, suppliers, and taxes, without holding excessive idle cash that could be put to better use. A key part of this is cash forecasting, where the analyst projects the company's incoming and outgoing cash flows to anticipate future needs or surpluses. The second pillar is risk management. Companies face various financial risks just by operating their business. For an international company, a sudden change in currency exchange rates could dramatically impact the value of its sales or the cost of its raw materials. A change in interest rates could affect the cost of its debt. The Treasury Analyst helps identify, measure, and hedge these risks. For example, they might be involved in executing financial transactions using derivatives, like forward contracts or options, to lock in a specific exchange rate for a future transaction, thereby protecting the company from adverse currency movements. The third pillar is capital and funding management. Companies need capital to operate and grow, and this capital comes from two primary sources: debt like bank loans or bonds, and equity, which is ownership. The Treasury Analyst supports the management of the company's capital structure. This might involve analyzing different funding options, ensuring the company is complying with the terms of its loan agreements, known as debt covenants, and managing the relationships with its banking partners and credit rating agencies. They help answer strategic questions like, is now a good time to borrow money? Or what is the most cost-effective way to fund our next big project? The skills required for a Treasury Analyst are a specific blend of quantitative and qualitative abilities. A strong understanding of financial markets, banking, and economics is essential. They need to be highly proficient in spreadsheet modeling and, increasingly, treasury management software systems. Because they are the primary point of contact with the company's banks, strong communication and relationship management skills are also crucial. Finally, given their role in protecting the company's assets, an unwavering commitment to ethics and integrity is paramount. The career path in Treasury offers a unique and highly specialized route within corporate finance. An analyst can progress to roles like Treasury Manager, Assistant Treasurer, and ultimately, the Treasurer, who is often a senior executive reporting directly to the Chief Financial Officer (CFO). This path provides deep expertise in how capital markets and banking directly impact a corporation. In summary, the treasury analyst plays a vital protective role. They are the experts who manage a company's lifeblood, its cash, ensuring its financial stability and safeguarding it from the unpredictable nature of global markets. Thank you for listening. In our next chapter, we will continue to explore the theme of protection as we look at another crucial role within a corporation: the risk management analyst. Hello and welcome back. In our previous chapter, we explored the world of corporate treasury, focusing on the professionals who protect a company's cash and manage its financial market risks. Today, we broaden our perspective on protection and delve into the discipline of risk management. We'll be examining the role of the risk management analyst, a corporate sentinel whose job is to identify and neutralize a wide array of threats to the entire organization. As we begin this discussion, we reaffirm our commitment to providing educational content. This chapter is for informational purposes only and is not intended as financial, business, or legal advice. The field of risk management is vast and complex, and our goal is to understand the function of the professionals who operate within it. While the Treasury Department focuses primarily on financial risks like currency and interest rate fluctuations, the risk management team takes a much broader view. They are concerned with the entire spectrum of risks a company might face. These can be categorized into several key areas. Operational risks are threats that arise from a company's day-to-day activities. Things like a supply chain disruption, an equipment failure, or a cybersecurity breach. Strategic risks are bigger picture threats that could affect the company's ability to achieve its long-term goals, such as a new competitor entering the market or a major shift in consumer preferences. Finally, compliance risks are related to the threat of violating laws, regulations, or internal policies. The risk management analyst is the on-the-ground professional tasked with executing the firm's risk management framework. Their work follows a clear, cyclical process: identify, assess, mitigate, and monitor. The first step is risk identification. Analysts work with business leaders across the entire company to proactively identify potential threats. This is a highly investigative process. It involves conducting workshops, analyzing historical data on past incidents, and staying current on industry trends and external events. They ask the critical what-if questions. What if our largest supplier goes out of business? What if a new data privacy law is passed? What if a natural disaster hits one of our key facilities? Once a risk is identified, the next step is to assess it. The analyst evaluates the likelihood of the risk occurring and the potential impact it would have on the business, both financially and reputationally. This allows the company to prioritize its efforts, focusing on the most severe threats. For example, a minor office supply shortage has a low impact, while a complete factory shutdown has a catastrophic impact. The analyst's job is to quantify this and present it clearly. After assessing the risks, the analyst works on mitigation strategies. This is about developing plans to reduce the company's exposure. Mitigation can take many forms. It might involve implementing new safety protocols, purchasing insurance, diversifying the supply chain, or investing in new cybersecurity software. The analyst helps develop these plans and builds the business case for the necessary investments. Finally, the process comes full circle with monitoring and reporting. Risk is not static, it's constantly evolving. The analyst continuously tracks the identified risks and the effectiveness of the mitigation strategies. They prepare reports and dashboards for senior management and the board of directors, providing a clear and up-to-date picture of the company's overall risk profile. The skills required for a successful career in risk management are distinct. A strong analytical and critical thinking mindset is the foundation. You need to be able to connect disparate pieces of information to see a potential threat before it materializes. A deep understanding of business operations is crucial, as is knowledge of relevant laws and regulations in the company's industry. And because the role involves working with every department, excellent communication and influencing skills are essential to get buy-in for risk mitigation strategies. The career path for a risk management analyst can lead to specialized roles, such as a specialist in cybersecurity risk or supply chain risk, or to broader leadership positions like risk manager, director of risk, and ultimately the chief risk officer (CRO), a top-level executive at many large corporations. In conclusion, the risk management analyst is a forward-looking protector. They help the organization navigate an uncertain world, not by avoiding all risks, which is impossible in business, but by understanding and managing them intelligently, enabling the company to pursue its goals with confidence. Thank you for joining us. In our next chapter, we will shift our focus to a highly client-facing role that blends finance with relationship management: the commercial banking relationship manager. Hello and welcome back to our series. We've journeyed through the analytical worlds of investment banking and corporate finance, exploring roles that are often centered on models and spreadsheets. Today, we shift our focus to a role where finance and human connection intersect directly: the commercial banking relationship manager. This is a position for those who not only understand numbers, but also excel at building long-term, trusted partnerships with business owners. As we explore this role, we'll continue to follow our guiding principle. This content is for educational and informational purposes only. It is not intended as financial, business, or legal advice. Our goal is to understand the function of a relationship manager and their importance to the business community. First, let's clarify what commercial banking is. While retail banking serves the needs of individuals, commercial banking is the side of the bank dedicated to serving businesses. This can range from a small, family-owned manufacturing company to a large regional corporation. Commercial banks provide the essential financial products and services that businesses need to operate and grow, including business loans, lines of credit for managing day-to-day expenses, commercial real estate loans, and cash management services. The Commercial Banking Relationship Manager, or RM, is the primary point of contact and the face of the bank for its business clients. They are far more than just salespeople. They are strategic advisors. The core of their job is to build and maintain a portfolio of business clients, deeply understanding their operations, challenges, and goals. The work of an RM is built on several key responsibilities. The most important is client relationship management. A successful RM knows their clients' businesses inside and out. They know their industry, their key employees, their suppliers, and their customers. By building this deep trust, they become the first person the business owner calls when they have a financial question or need, whether it's about funding an expansion, buying new equipment, or managing international payments. Another key responsibility is credit analysis. When a business needs to borrow money, the RM is on the front line of the lending process. They are responsible for gathering the company's financial information, analyzing its cash flow and creditworthiness, and understanding the purpose of the loan. They work to structure a loan that not only meets the client's needs but also fits within the bank's risk tolerance. They act as the advocate for the client inside the bank, presenting the case to the credit underwriting team that makes the final approval. Relationship managers are also responsible for business development. This means they are actively involved in their local business community, networking and building connections to bring new clients to the bank. They are problem solvers who look for businesses that the bank can genuinely help succeed. A great RM also acts as a quarterback, coordinating a team of specialists within the bank to serve their client. If their client needs help with managing their company's cash flow more efficiently, the RM will bring in a treasury management expert. If the business owner wants to discuss their personal retirement planning, the RM can facilitate an introduction to the bank's wealth management division. They ensure the client has access to the full suite of the bank's capabilities. The skills for this role are a unique blend of hard and soft skills. The hard skills include a strong foundation in finance and accounting, and the ability to analyze financial statements to assess credit risk. But the soft skills are what truly set a great RM apart. These include exceptional communication, interpersonal, and negotiation skills. They must be skilled listeners, natural networkers, and trustworthy advisors. The career path often begins with a role as a credit analyst, which provides the foundational technical skills. From there, one can move into a junior or associate RM position before eventually managing their own full portfolio of clients. Successful RMs can advance to leadership roles, such as a team lead, a market manager, or even a regional president for the bank. In summary, the Commercial Banking Relationship Manager plays a vital role in the economy, serving as the bridge between financial capital and the businesses that create jobs and drive growth in our communities. It is a career that rewards both financial acumen and the ability to forge lasting human connections. Thank you for listening. In our next chapter, we will explore the world of serving individual investors directly as we look at the role of the financial advisor. Hello and welcome back. In our last chapter, we looked at the role of the Commercial Banking Relationship Manager, a trusted partner to businesses. Today, we turn our attention to a role that serves a similar function for individuals and families: the financial advisor. This is one of the most visible and personal roles in the entire finance industry, focused on helping people navigate their personal financial journeys. Before we proceed, it is absolutely essential to state this chapter's purpose clearly. This is a descriptive overview of the financial advisor profession. It is for educational and informational purposes only. The content is in no way intended to be financial, investment, tax, or legal advice for you, the listener. The goal is to understand what a financial advisor does, not what you should do with your own finances. All personal financial decisions should be made in consultation with a qualified, licensed professional. So, what is a financial advisor? A financial advisor is a professional who works with clients to help them understand their complete financial picture and develop strategies to meet their personal life goals. You might hear various titles like financial planner, wealth manager, or investment advisor, but the core function is to provide guidance on a wide range of personal finance topics. This includes planning for retirement, saving for a child's education, managing an inheritance, making decisions about insurance, and preparing an estate. The work of a financial advisor is typically structured around a comprehensive financial planning process. This process is a long-term partnership that begins with discovery and goal setting. In this initial stage, the advisor's primary job is to listen. They ask questions to understand a client's values, priorities, and what they want to achieve in life. They also gather detailed information about the client's current financial situation, their income, expenses, assets, and liabilities. Once they have this holistic view, the advisor moves to the second stage, analysis and plan development. They analyze the client's information and begin to construct a personalized financial plan. This plan acts as a roadmap, outlining a series of proposed steps and strategies designed to help the client move from where they are today to where they want to be in the future. The third stage is implementation. If the client agrees with the proposed plan, the advisor helps put that plan into action. This can involve a variety of tasks, such as helping the client open the appropriate types of investment and retirement accounts, assisting in the selection of insurance policies, or coordinating with other professionals, like an accountant for tax planning, or an attorney for estate planning. The final stage, which is ongoing, is monitoring and review. Life is not static. People change jobs, have children, and their goals evolve. A financial plan needs to adapt. The advisor and client typically meet on a regular basis to review the progress of the plan, measure it against the client's goals, and make any necessary adjustments along the way. A critical aspect of this profession in the United States is the standard of care an advisor is held to. It's important to understand the difference between a fiduciary standard and a suitability standard. A professional held to a fiduciary standard is legally obligated to act in their client's absolute best interest. A professional held to a suitability standard is required to ensure their recommendations are generally appropriate for a client's situation. This distinction is a key feature of the regulatory landscape for financial professionals. Ultimately, a huge part of an advisor's role is that of an educator and a coach. They work to demystify complex financial topics, explain the pros and cons of different options, and provide discipline and guidance, especially during periods of market uncertainty. The goal is to empower clients to make informed and confident decisions. Success in this field requires a unique combination of skills. A strong understanding of financial concepts, markets, and regulations is the foundation. But beyond that, an advisor must have exceptional empathy, listening, and communication skills. They are in the business of trust. Many professionals in this field pursue rigorous certifications to demonstrate their expertise and commitment, with the Certified Financial Planner, or CFP, designation being one of the most recognized. In summary, the financial advisor acts as a long-term guide and partner, helping individuals and families build a clear path toward their most important life goals. Thank you for listening. In our next chapter, we will pivot dramatically from the high-touch world of personal advice to the highly mathematical and data-driven world of the quantitative analyst. Hello and welcome back. In our last chapter, we discussed the highly personal, relationship-driven role of the financial advisor. Today, we take a 180-degree turn and venture into one of the most intellectually demanding and mysterious corners of the financial world. We're going to explore the role of the quantitative analyst, more commonly known as a quant. These are the mathematicians, physicists, and computer scientists who build the complex algorithms that power modern finance. As we step into this highly technical field, our standard disclaimer is more important than ever. This overview is for educational and informational purposes only. It is not investment advice. The strategies and models discussed are described to illuminate a career path, not to be replicated or used for personal trading. So what is a quantitative analyst? A quant is a specialist who applies mathematical and statistical methods to financial and risk management problems. While a traditional analyst might read financial statements and form a qualitative judgment about a company's future, a quant builds sophisticated mathematical models to identify patterns, price complex financial instruments, and execute trades, often at speeds impossible for a human. They look for an edge not in a company's story, but in the data and the math that underpin the market. The term quant is broad and covers several distinct roles, which can generally be grouped into three categories. First, you have the front office or desk quants. These professionals work directly alongside traders on the trading floor. Their primary job is to create and maintain models for pricing complex derivatives, such as options and swaps, whose value depends on multiple variables. They also help traders develop models to manage the risk of their trading books in real time. Their work is extremely fast-paced and directly tied to the firm's daily profitability. The second category is the quantitative researcher, who often works at hedge funds or proprietary trading firms. These are the architects of automated trading strategies. Their job is to sift through massive amounts of historical market data, looking for statistical patterns or alphas that can be used to predict future price movements. Once they discover a potential pattern, they build a trading algorithm based on it and then backtest it rigorously against historical data to see if it would have been profitable. If successful, this algorithm might be deployed to trade automatically in the live markets. The third group is the risk management quants. These professionals work to protect the entire financial institution from catastrophic losses. They build the large-scale statistical models that firms use to manage their overall market risk, credit risk, and operational risk. For example, they develop the value at risk, or VAR, models that estimate the maximum amount of money a firm could lose on a given day. Their work is less about generating profit and more about ensuring the firm's long-term stability and satisfying regulatory requirements. As you might imagine, the skills required to be a quant are highly specialized. This is a field dominated by individuals with advanced degrees, often a PhD or a master's, in highly quantitative disciplines like mathematics, physics, computer science, statistics, or financial engineering. The foundational skills include a deep knowledge of advanced mathematics, including calculus, probability theory, and linear algebra. Strong programming skills are non-negotiable, with languages like Python and C++ being the industry standard. Finally, expertise in statistical analysis and data science is essential for finding signals in noisy financial data. The career path for a quant is less about climbing a traditional corporate ladder, and more about becoming a deeper and deeper subject matter expert. A successful quant can become a leader of a research team, manage a portfolio of quantitative trading strategies, or even leave to start their own quantitative hedge fund. It is a highly meritocratic field where the quality of your ideas and models is what truly matters. In conclusion, the quantitative analyst is at the cutting edge of finance, operating at the intersection of data, technology, and markets. It is a field for intense problem solvers who are driven to find order and predictive power in the complex world of global finance. Thank you for joining us. In our next chapter, we will look at another highly specialized role that is crucial for the integrity of the financial system: the compliance officer. Hello and welcome back. In our last chapter, we delved into the highly mathematical world of the quantitative analyst. Today we shift from the architects of algorithms to the architects of integrity. We're going to explore the crucial role of the compliance officer, a professional whose primary job is not to generate profit, but to ensure that a financial firm operates ethically and within the strict boundaries of the law. As we discuss this legal and regulatory-focused profession, our standard disclaimer is especially important. This chapter is for informational and educational purposes only and does not constitute legal, financial, or any other form of professional advice. Our goal is to understand the function of a compliance professional within the financial industry. So what is compliance? In the context of finance, compliance is the department within a firm responsible for making sure that the company and its employees adhere to all relevant laws, regulations, and internal policies. The financial industry in the United States is one of the most heavily regulated sectors of the economy for a reason: to protect consumers, prevent financial crime, and ensure the stability and fairness of the markets. The compliance department is the firm's internal mechanism for upholding these critical standards. The role of a compliance officer is multifaceted, but it can be understood through four key functions: advising, monitoring, policy-making, and training.
Disclaimer: the information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
First, compliance acts as an advisor to the business. Before a new financial product is launched, a new marketing campaign is created, or a new trading strategy is implemented, the business teams will consult with the compliance department. The compliance officer's job is to provide guidance on the applicable rules, review materials for fairness and accuracy, and help the business achieve its goals without breaking any regulations. They are proactive partners in risk prevention. The second function is monitoring and surveillance. Financial firms are required to monitor employee activities and communications to detect potential misconduct. Compliance officers use sophisticated software to scan for red flags in trading patterns that might suggest insider trading or market manipulation. They also review employee emails and other communications to ensure that clients are being treated fairly and that confidential information is being protected. When an alert is triggered, it is the compliance officer's job to investigate it. Third, compliance is responsible for policy and procedure development. Regulations can be thousands of pages long and incredibly complex. A key role for a compliance officer is to take these complex external rules and translate them into a clear, practical set of internal policies that employees can easily understand and follow. They essentially write the firm's operational rulebook. Finally, a huge part of compliance is dedicated to training and education. From the first day a new employee joins the firm, the compliance department is responsible for training them on the rules of the road. This education is ongoing, with mandatory annual training sessions to keep all employees up to date on new regulations and firm policies. To thrive in a compliance role, a specific skill set is needed. This is not a role for a quantitative modeler, but for a critical thinker. Exceptional attention to detail, strong analytical skills, and most importantly, an unwavering ethical compass are the foundations. Excellent communication skills are also vital, as compliance officers must be able to explain complex rules to a wide range of people, from junior staff to senior executives. While not always required, many compliance professionals have a background in law or paralegal studies. The career path in compliance is robust and has grown significantly in importance over the last 2 decades. One might start as a compliance analyst and then specialize in a specific area, such as anti-money laundering, AML, advertising review, or trade surveillance. From there, the path leads to roles like compliance manager, and ultimately to the chief compliance officer, CCO, who is a senior executive responsible for the entire compliance program of the firm. In conclusion, the compliance officer is an essential guardian of a financial firm's integrity and reputation. They work diligently behind the scenes to ensure that the markets are fair, clients are protected, and the firm's conduct is beyond reproach. Thank you for listening. In our next chapter, we'll return to the world of investing, but with a focus on innovation and the future, as we explore the role of the venture capital analyst. Hello and welcome back. In our last chapter, we examined the role of the compliance officer, a professional dedicated to ensuring stability and adherence to rules. Today, we leap from the world of established procedure to the world of radical innovation. We're going to explore the role of the venture capital analyst, a unique position at the intersection of finance and the future, where the goal is to find and fund the next generation of world-changing companies. As we discuss this high-risk, high-reward field, we must emphasize our core principle. This overview is for educational purposes only. It is not an endorsement of any specific investment, and is not financial or investment advice. Our goal is to understand the professional career of a venture capitalist, or VC. What is venture capital? In simple terms, venture capital is a subset of private equity that focuses on investing in startups, early stage, and emerging companies. These are businesses with a novel idea or technology, but little to no revenue or track record. A VC firm raises money from large institutional investors into a fund. It then uses this fund to make many small investments in these improving companies. The core strategy is built on the understanding that most of these startups will fail. However, the hope is that 1 or 2 will become massive successes. The next Google, Amazon, or Airbnb, generating returns so large that they more than cover the losses from all the others. The venture capital analyst, often called an associate, is on the front lines of this search for the next breakout company. Their job is fundamentally different from many of the other analyst roles we've discussed. It's less about analyzing historical financial data, and more about scouting for talent and visionary ideas. A huge part of the role is deal sourcing. This is the active hunt for investment opportunities. An analyst can't just wait for business plans to arrive. They are expected to be deeply embedded in the startup ecosystem. This means attending tech conferences and demo days, building a strong network with entrepreneurs and engineers, and keeping up with the latest technological breakthroughs. Their job is to find the most promising founders and ideas before their competitors do. Once they find a potential investment, the next step is screening and due diligence. A typical VC firm might look at thousands of companies in a year, but will only invest in a very small number, perhaps less than 10. The analyst is the first filter. They review countless pitch decks, take initial meetings with founders, and decide which opportunities are worth a deeper look. The due diligence process in VC is also unique. While they will look at any available financial projections, the focus is much more on qualitative factors. What is the size of the potential market? Is the technology truly disruptive? And most importantly, is this founding team exceptionally talented, resilient, and obsessed with solving the problem they've identified? Beyond evaluating individual companies, VC analysts are responsible for market research and thesis building. They often become experts in a specific sector, like financial technology, fintech, artificial intelligence, or biotechnology. They are tasked with developing an investment thesis, a point of view on where the industry is heading and what types of new companies are needed to solve future problems. This research helps the firm's partners make more informed investment decisions. The skills required for venture capital are a distinct mix. Financial modeling is useful, but far less critical than in traditional private equity. Instead, what's truly valued is a deep intellectual curiosity and a genuine passion for technology and innovation. Strong networking and interpersonal skills are non-negotiable, as the job is about building relationships with founders. An analyst must be an optimist who can envision how a tiny startup could one day become a global leader, but also a sharp critical thinker who can poke holes in a business plan. The career path in venture capital is less structured than in other areas of finance. Many successful VCs come from operational backgrounds, having been startup founders or product managers themselves. The typical progression is from analyst or associate to a more senior role like principal, and finally to partner, who has the authority to make investment decisions, and will often take a board seat at the companies they invest in, providing mentorship and guidance. In summary, the venture capital analyst is a talent scout for innovation. They provide the crucial first check, and the belief that helps visionary founders turn ambitious ideas into reality. Thank you for listening. In our final chapter, we will bring everything together, summarizing the key paths in finance, and offering a framework for how to think about finding your place in this diverse industry. Hello, and welcome to the final chapter of our series, exploring different finance roles in the U.S. We've been on an incredible journey together, from the high-stakes trading floors of investment banks to the strategic heart of corporations, from the innovative world of venture capital to the vital work of compliance. Our goal has been to draw a detailed map of this vast and varied industry. In this concluding chapter, we will put it all together, offering a framework to help you make sense of these diverse paths. Before we begin our summary, we must state our most important disclaimer one last time. This series, and especially this chapter, is for educational and informational purposes only. It is not career advice. The frameworks we discuss are meant to be a guide for your own thinking and research. Personal career decisions are deeply individual, and should be made after careful introspection and consultation with mentors, professors, or career counselors. To make sense of the many roles we've covered, it can be helpful to think of the finance world as having three distinct, though often overlapping, arenas. The first is the arena of capital markets. This is the world of high finance often depicted in movies, centered on investing and large-scale transactions. The roles we've discussed here include the investment banking analyst, the private equity analyst, the hedge fund analyst, the mutual fund analyst, and the quantitative analyst. These professions are defined by their direct connection to the markets. They involve analyzing securities, structuring deals, and managing large pools of capital. If you are energized by the fast pace of the global economy, enjoy deep analytical challenges, and thrive in competitive, performance-driven environments, the roles within this arena may be worth your exploration. The second arena is corporate finance. This is the financial engine inside a non-financial company. Here, we explored the roles of the FP&A analyst, the treasury analyst, and the risk management analyst. Unlike the capital markets arena, the focus here is internal. Professionals in these roles are strategic partners to the business, helping it plan for the future, manage its cash, and protect itself from harm. If you are fascinated by the mechanics of how a business operates, enjoy collaborative problem-solving, and seek to have a direct impact on a company's strategy and health, the world of corporate finance offers a wealth of stable and rewarding career paths. The third arena can be called client and regulatory services. This arena is built on the foundations of trust, relationships, and integrity. The roles we've examined here include the commercial banking relationship manager, the financial advisor, and the compliance officer. While very different from each other, they are all united by a focus on serving and protecting. Relationship managers and financial advisors focus on serving external clients, whether businesses or individuals, helping them achieve their financial goals. Compliance officers, on the other hand, serve to protect both the firm and the financial system itself. If your primary motivation comes from building long-term relationships, helping people directly, or upholding rules and ethics, roles in this arena could be an excellent fit. As you reflect on these arenas, consider the types of skills and personal attributes that resonate most with you. Is your passion in deep, quantitative analysis, or is it in building empathetic client relationships? Are you a deal maker or a business builder? Are you a market strategist or a guardian of the rules? There is a place for all of these talents in finance. Embarking on a career is a journey of discovery. The most important thing you can do is remain curious. Talk to people who work in these fields. Read industry publications. The map we've provided in this series is a starting point. It is now up to you to explore the territory. Remember that careers are rarely a straight line. The skills you learn as a financial analyst in a corporation can be immensely valuable if you later decide to work for a mutual fund. The discipline you learn in compliance can make you a better investor. Thank you for joining us on this comprehensive tour of finance roles in the United States. We hope this series has demystified the industry and provided you with a clear, unbiased, and valuable foundation for your own journey of exploration. We wish you the very best in whatever path you choose to pursue.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.